Welcome back to the portfolio, everyone. And today we're giving you 6 stock ideas for you to take a look at this week. All 6 of these companies report earnings this week, and whenever earnings report comes out, there's usually some stock price volatility, and maybe you can get a good price on these companies if you believe they're fit for your portfolio and they will perform well long term. So we're going to go through 6 different companies that operate in a couple different sectors. They all report earnings this week, and I really think it would be a great time to take a look at them to determine whether or not you want to add them to your portfolio. And if you do want to add them to your portfolio, this week may be the week to do just that. So before we jump into the first pick, I am going to ask you, can you please like and subscribe? I really do appreciate everyone who does that, and it really does help my channel grow. So the first pick on this list of stocks that report earnings this week that I think you should take a little look at is, of course, Disney. So Disney does report earnings this week, and of course we all know that all their parks have been shut down, all their cruise lines have been shut down, so it's going to be very interesting to see if Disney will report decent numbers. Personally, I don't think they will, and of course they do pay a dividend right now of 1.67%, but that dividend is considered unsafe right now from sources such as Simply Safe Dividends, because they have that lack of revenue coming in, and there's a lot of uncertainty to when people are going to be allowed to gather in such large crowds once again, that we don't know when Disney's main revenue streams are going to come back through their parks and through their cruise lines. Of course, everyone knows they do have projects such as Disney Plus out right now, but even though they have grown that very rapidly to over 50 million subscribers very quickly, and they are bringing in revenue from that source and many other sources, it is still not enough to replace the lost revenue from the closure of their parks and attractions. So it's going to be very interesting to see what Disney is going to report and how the stock price is going to be impacted from that report. If you do believe in Disney long term, then this may be the time to jump in. If you believe the company is going to stay available and stay open, and when all this stuff goes away and the economy goes back to normal, and when we can all gather in large groups once again, and people start going back to Disney parks, and you believe that's going to happen, Disney's going to go back to the strong company that it once was, then this might be the time to buy. This week might give you a great opportunity to jump in when the price may dip, may go up, who knows? But I'm just going to assume that when companies report bad earnings, of course, it's the understanding that people may sell out of the company. We really don't know if that's actually going to happen or not, but this may be the week that you want to take a look at Disney, and of course, maybe be the time to jump in. Regarding Disney's dividend, they do pay that tiny 1.67% dividend, and they have not been growing it very fast. They do have only very slow dividend growth, but because of the uncertainty of their revenue, and we don't know how long they will be without some of their main revenue streams, their dividend is considered unsafe, and it may be cut in the future, and I wouldn't be surprised personally if it does get cut. So that was stock number 1 for you to take a look at, Disney. The next stock that reports earnings this week is Shopify. Ticker symbol SHOP, S-H-O-P. They're currently trading at a value at $613 a share. And if you don't know what Shopify does, they are a platform where individuals and companies can go on and create online selling sites and online websites where you can sell their products. And of course, during this time right now, when a lot of people are buying items online, a lot of stores are increasing their online presence and are creating more digital merchant sites and different sites where they can sell and advertise their products. So that is exactly what Shopify does. It's a great platform to use to sell products online. And I've personally used them, and I can vouch for the actual product. I am a fan of the product they promote and they give out to consumers. So this is good for consumers and businesses. And of course, if you look at their 1-year chart here, Shopify, of course, did take a dip like the overall market, but it has recovered very nicely and it has reached a new all-time high. So of course, some people may be wondering, why am I sharing this stock if it is at an all-time high? That's just because this is a company that is reporting earnings this week. And whenever companies do report earnings, sometimes even good earnings lead to a decrease in stock price. The market is very unpredictable. So when you want to take a look at these companies, all these companies have earnings this week, and I want to throw in some solid companies on this list. Even if they are trading at all-time highs, who knows how high Shopify can go? We don't know when the peak is, and this is a solid company, so it'll be interesting to see if their earnings are good, bad, and what's going to happen. So keep an eye out for Shopify if you think it can be a good addition to your portfolio. The third stock on this list is a stock I mentioned in my top stocks in the video game sector, and this is Activision Blizzard. So ticker symbol ATVI. This is a video game company. They own and distribute some of the biggest video game brands throughout the world, such as Call of Duty and World of Warcraft. As you can see here on the 1-year chart, of course, like every company in the market, they did see that small dip in the month of March, but once again, it has recovered from that dip and is a bit higher than it was 3 months ago. They do pay a tiny dividend of only 0.6% and have a market cap of around 50 billion. So this is a decent sized company. They have been growing revenues pretty nicely year over year. And of course, with all these prolonged stays at home, video games are seeking demand. Right now, people need things to entertain themselves with, and video games are what they're choosing to do that. So if we look over their dividend safety, they actually have the highest dividend safety score available on Simply Safe Dividends at a score of 99. Their dividend is very safe. Of course, they're only paying out that 0.63% yield, so you're not in this for the yield. And of course, they have been growing it very fast because the yield is so low, their payout ratio is so low that they are actually able to grow their dividend very quickly. And if we take a look back at their chart, this is a stock for price appreciation. As you can see here, only a year ago, the stock was trading around $50 a share, now currently up to around $65 a share, even during this time of market uncertainty. And this is a sector in the market that I believe, in my personal opinion, is going to continue to grow and generate revenue during these times because they can sell a lot of their video games digitally. You don't have to go to a store to physically buy their video games anymore. You can buy them online through your video game console, which has allowed the company to continue to bring in revenue even during these times when everyone is staying home, bored, and needs something to do. The next stock on this list, this is number 4 on the top 6 stocks to take a look at this week, and this is PayPal. So PayPal reports earnings this week as well, and like I said, these companies all report earnings in this week, which could lead to some stock price volatility and may create some buying opportunities if these fit your personal investing needs. So of course, PayPal, if you don't know what it is a middleman essentially in the online platform and online buying and selling universe. So of course, PayPal is somewhat like a digital wallet where you can have money in your PayPal account and you can use that to securely make purchases from online digital retailers. So of course, PayPal is in demand right now because of what's going on, and everyone is now at home, and there has been an increase in online demand purchases, and people are now purchasing more products online using PayPal to make those purchases and using PayPal in the middle of those purchases, and PayPal should be collecting fees from the merchants in order to facilitate those deals and facilitate those transactions. So if you look at the 1-year chart for PayPal, as you can see, they took that hard dip just like the overall market, and have all these stock prices have seen a similar dip in price. But once again, like I said, it has recovered. So this is another company that if you want to take a look at right now, the stock price may be volatile during this week. And if the earnings are good or bad, who knows, it may create a nice buying opportunity. And if people might wonder, and I once again say, why am I recommending a stock at this all-time high? Of course, this is not any recommendations. In no way am I recommending any companies. I'm just sharing with you some companies that report earnings this week that you may want to take a look at and maybe think if they fit your portfolio, maybe want to take a look at and maybe think about doing some further research into them. So PayPal currently around $120 a share. And of course, if you look back, literally about 6 to 8 months ago, PayPal was trading at that same value. So this might give you an opportunity to purchase a stock that you believe has a good long-term future at the same price it was trading 6 months ago. So you are getting that little bit of a discount. It'll be interesting to see what happens with PayPal moving forward. Stock number 5 on this list is Uber. So of course, we all know what Uber does. It is a ride-sharing platform, and of course, it was one of the leading innovators in that space. Currently trading at $28 a share, ticker symbol UBER. Of course, that spells out Uber. Their market cap around $50 billion right now, so they are decent sized companies. Their profits have been almost non-existent for Uber, and it's very interesting to see how this company will perform moving forward and what their earnings are going to be like. Because of what's going on, and we all know that, I can say this for every single company, people aren't going out as much right now, and I'm sure people are a lot more uncomfortable to get in cars with a bunch of random people or strangers who don't know who they are, especially they don't know how many people have been in those cars over the past day or week. So I'm pretty sure Uber is going to have some decline in revenue right now because of lack of use. I'm sure there's going to be a large part of their revenue stream is going to decline. This is also obviously my opinion and my assumption. I'm not for sure yet. We have to see what the earnings report states. But I just believe that there's going to be less people eager to just jump in an Uber. For a lot of people before who were comfortable with Ubers, it was just a second thought. They had to go somewhere, they pulled out their phone, they got on the app, and they called an Uber. But now it might make them have some second guesses on whether or not Uber is the safest and best method of transportation for them right now. So it might create some uncertainty with revenue regard for Uber. So if you believe in Uber long term and you believe they're going to continue to innovate, continue to come out with different products and different styles of their company that are going to continue to grow revenues and hopefully grow the share price, then this may be the time to buy if you're really interested. So this is the last company on this list we're going to jump over to, CVS. So of course, CVS Pharmacies, ticker symbol CVS. It trades at just under $60 a share right now. They do pay a nice 3.35% dividend and are trading at a market cap at around 80 billion. So this is the sixth company on this list that does report dividends. So of course, if we look at just this key summary here, you can see if you don't know what CVS does, of course they own retail pharmacy locations. They have close to 10,000 retail locations in their pharmacy. And of course, they have 1,100 Minute Clinic locations. So they do operate within the healthcare sector and the healthcare sector services. So of course, they are open during these times, and they are and should be still generating some decent revenue during these times because people still need their products. They sell essential products that people will continue to have demand for even during these uncertain times. And CVS might have an opportunity to actually generate and gain a little bit of market share when some of their competitors may be closed. So that will be interesting to see what CVS does during these times. And if we move over to their dividend right here, so they do pay out 3.35% dividend yield, and their dividend has a very low payout ratio at only around 28%, and they have been rapidly growing their dividend of over 12% over the last 5 years. Of course, they did not grow their dividend last year, which is not great to see, but over the past 5-year growth rate is still around 12%. So this isn't the best type of dividend play, but if you are looking for this company right now and you do believe it is kind of, I'm going to so-called say recession proof because their products are still in demand during these times, then buying this stock right now with a nice over 3% dividend, a low payout ratio, may not be the worst thing in the world. So if that's it for this video, those are the 6 companies that I believe you should take a look at this week. They all report earnings. They all are operating in different sectors and may have different performance. We'll see how their earnings do pan out, and it will be very interesting to watch and see how they perform moving forward. So if they fit your investment criteria and you believe they can be part of your portfolio, take a look at them. And I do appreciate you tuning in. I am the Gen Z investor, and we talk about personal finance and investing. And for everyone who did stick around to the end, I do appreciate it all. And please like and subscribe, and I'll catch you in the next one.